Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the U.S. dollar. We'll look at how it's affecting oil, gold, silver, and other commodities, maybe even Bitcoin. And then from there, we'll move on to chart requests. There's been it's an interesting week so far. And there's a little bit of extra stuff to cover today, as a lot of equities are kind of pulling back in price. If you like what you see here, you can always follow me on Twitter under the name Stock Darts. You can find these videos also under YouTube under the same name, Stock Darts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, watch list ideas, or any general thoughts I might have on trading or the markets. It's probably the best place to go if you're looking for extra content from me. We also repost these Wednesday market reviews as well. Other than that, let's go ahead and get started. First thing I'm going to do is take a look at the S&P 500 through the ETF SPY. As you can see, we've got a red candle. We've got several red candles that have taken place over the course of the last week and a half. For those of you that were here last Wednesday, we discussed the possibility of a market pulling back, and actually had come to the conclusion that the market was, at this point, flipped from bullish to bearish in the short term. Now, I think intermediate to long term, we're still fine. But I think in the short term, we have definitely turned around and started looking for where buyers are willing to step up and defend the price action. And I think that's kind of where we are right now. It hasn't been a good maybe month now, maybe month and a half of trading. And I feel like that's probably going to continue. That's something that I've been focusing on a lot during my posts in my patreon.com page. The market's just not in a spot right now where it's giving us good odds or good opportunities. And as I said, I feel like that's going to continue. That's something we've been harping on. Those of you that have come every Wednesday, you'll know that I've been a little bit more cautious about the market. And there is every bit of the possibility that we will turn around and bounce at these current levels. As you see, as we go over the four major market indices, you'll see that we are at an inflection point where things could turn a bit more negative, or we could get a bounce and we could get a little bit of better opportunities as far as trading is concerned. But at the moment, things are looking a little bit ugly as far as trading opportunities are concerned. But like I said, I don't think it's any reason to panic. I think this is still a short-term thing. I don't think it's anything to be concerned with as far as the longer-term picture is concerned. My feeling, and it's a feeling that I've had for a while now, is that we've been transitioning towards a more sideways market, and it's not really reflected across the board yet, but it's something that we're kind of shifting towards, and I think that will continue as we head into the summer months. And as traders, we have to understand or anticipate what the market is looking like it wants to do, and start to kind of adjust our expectations and our trading style to kind of match that. And that's something I've done already. Those of you that, like I said, regularly read whatever I post on the Patreon page, you'll know that I've been taking it very cautiously and kind of sitting on my hands. I'll look at a couple trade ideas that are likely to not work, but if they do work, they'll give me a really good high probability setup. And rather than trying to force the issue and trying to go ahead and actively overtrade this market, I've just been very careful, focusing in other areas like cryptocurrencies, which actually took a very big hit recently as well. And so at this point, it's really one of those situations where I'm just kind of limiting my risk and doing my best to kind of make sure that I don't lose anything while the market offers us poor trading setups. For those of you that are maybe into poker, it's often poker analogies are often used to kind of compare to market trading. And I think that this is one of these situations where if you play poker, you'll know that you don't really need to play every card that you get, right? There's a lot of times you get bad hands and you just fold them before you ever put any money into the table. And we're in a situation right now where the market is giving us bad hands. It's giving us a bunch of single digits, not connected. So you're looking at like a 3 and an 8, or a 4 and a 7, and nothing that's really worthwhile to trade. What you want to do as a trader is you want to wait for the market to give you, aces, kings, queens, or even maybe like an 8 and 9 connected or something along those lines, where you have the possibility of something that could pay off for you. But what it's giving us right now are not really good possibilities or good payoff potential. Now, you might think to yourself, well, if that's the case, shouldn't I be shorting? And see, that's the problem. The market isn't giving us a good setup. That means it's not giving us a good setup, long or short. Um, if you follow me regularly, you'll know that I haven't really recommended a short trade in a long time. That doesn't mean I'm some kind of permabull that never likes to short or is ethically against it or anything of that nature. It's just that the market hasn't really been in a spot where shorting has been really profitable. If we go ahead and take a look at the weekly chart, and we just kind of see where we've been and what we've done over the last 4 or 5 years, right? We can go. Let's go all the way back to say 2017. Actually, no, we'll go all the way back to 2015, right? So here we're looking at 6 years now, right? And you'll notice, for the most part, it's been straight up, right? We did have a nice broad consolidation range from 2015 to 2017. And at this point here, I think was the last time that I even remotely looked at shorting stocks, was when we were kind of reaching a point where we would hit the top of the range and drop right back to the bottom, hit the top, drop right to the bottom. And at that point, I think that's the last time I even considered shorting. And then we took off. And at this point, this was a little bit more tricky because we did have this really big drop-off at the end of 2018. But we quickly kind of rebounded, and then of course the coronavirus drop that we had was so quick that it really wasn't a good idea to try to short that anyway. Now there are some that, these black swan events, you can go ahead and try to take advantage of the momentum, but typically during these types of scenarios, that's when I usually just wait for the conditions to kind of get a little bit more predictable and a little less volatile. But as you can see, we've basically had, I would say 4, maybe 5 different types of market structures. We had the sideways market, we had the ramp up that started around 2017 and ran all the way up, and really it kind of continued up into 2018. But as you can see, there was a transition stage where we continue to ramp up, but we're already kind of going sideways, right? And that kind of played out where we kind of just played sideways, and then eventually ramped up, and then this right here you could kind of count as a whole separate scenario, which was the whole black swan thing with the coronavirus. If we just ignore that, you'll see that we had just kind of a straight ramp up, right? And what we're having now is a situation where I feel we are kind of in this area, right, where we're still kind of climbing up, but we're already kind of transitioning towards a sideways market. And as you can see, if we go even further back, this happened before as well, right? We had another strong rally that basically from about 2012 to about 2015, and you'll note that even at the end we were kind of ramping up, but we had already kind of reached the spot where we were going to be trading sideways, and we just kind of gradually shifted towards that, right? And so my thesis has been that we are starting to reach a point where we are turning towards a more sideways market environment. And when that happens, there may be scenarios where once we have a pretty clear range established where shorting becomes a little bit more profitable or a little bit easier to kind of set up. But when you're in these transition stages where we are right now, it's very difficult, because what happens is you still have traders that are playing the long game, or playing playing to the long side, and you have others that are kind of starting to shift towards neutral. And what happens is when they mix together, you get really choppy price action, and that tends to be really difficult to trade, both as a bull or a bear, because you don't really get sustained moves in either direction. And when you do get a sustained move, it's often interrupted by quick moves once, back and forth. If you look even at the last, say, maybe 7 or 8 candles, and I'll zoom in a little bit for that, you'll note that we had a nice 3-day drop, but that was interrupted by 2 pretty good green days that probably shook out a lot of sellers that maybe tried to take advantage of this, and then we kind of turned right back around and we headed back down. And so there were buyers that tried to buy this that probably failed as well, and we headed right back down south. Now, those that are regulars here, you'll know that we were kind of anticipating this pattern. This is a pattern that happens very often in bull markets, where you come and you test the 20-day moving average, and eventually when you break it, you test the 50. And more often than not, when you bounce off the 50, you hit the 20 again, and you typically chop back and forth between them a couple times, and then eventually you get the resolution, usually in the same direction as the prior trend, which means that there's a pretty good chance that we still try to bounce here and get back above the 20 and try to head back to new highs. However, if we lose the 50, then we probably lose our trend here and we start trading more sideways. And as we get to the Nasdaq and IWM, you'll see that that's a pattern that's already played out on a couple of the indices, even if it hasn't really fully played out on the S&P 500 or the Dow Jones yet. And so, like I said, it feels to me like we're in a market that's in transition. Now, that being said, I've thought this has been the case since back in February. And that hasn't stopped me from taking long trades and from playing the overall momentum of the market upwards if it continues to go upwards. And I think that's really the key to keep in mind is despite whatever your thoughts are on the overall market and what you think it could do, if you're a trader, particularly a swing trader or a shorter to intermediate term trader, you still want to react to what the market does, and rather than kind of hold firm to your beliefs, you still want to go ahead and do what the market is doing. And so in my situation in particular, even though I think the market is transitioning towards a sideways state, I understand these things don't play out in the span of a day or two. These things span out over the course of weeks or months. And so there will still be some inevitable bullish moves, despite the fact that I feel like we are starting to roll over and starting to go trade sideways. And so even though I've kind of thought this was the process that began back here in February, the market shrugged off the selling pressure and was able to make a new run and a new rally. And if I had ignored that, I would have probably missed out on some good profitable trades, thinking that the market was ready to kind of shift sideways. And I think the key here is, well, another key I guess I should say is that because the long-term trend is still higher, I'm still focused on the long side, and I'm still looking to buy. The only thing that's changing is the parameters that I use as far as how to go ahead and structure trades, how picky I am about them, and what kind of profit-taking rules I have in place. So typically when a market is rallying like it kind of has done over the last 5-6 months now, you want to let your profits run. You want to scale out little by little, but you want to make sure that you try to take advantage of extra premium or extra moves up. When the market starts trading sideways, you're much more quick about taking profits, and you basically are trading from like target to target, and not really trying to trail the stop and try to get as much of the move out of it as you can. And so that's one move that one change that I've had now is I'm being a little bit more aggressive about taking profits on moves up and also stopping out on moves down, because the market isn't in a more, when the market is running up like this, it's a little bit more lax or less punishing, and is able to kind of let you kind of get away with little mistakes here and there. But when a market starts to trade sideways or correct downwards, it becomes a lot less lenient and becomes a lot more punishing, and you tend to take some big hits if you start to break rules or you start to ignore some of the discipline or some of the rules of money management that you should have in place. And so this is an important spot because we're in a market that's starting to become a little bit more punishing. It doesn't look like that if you're just looking at the S&P 500, but as we move forward and as we look across the board, and particularly if you have a nice big watch list like I do of stocks, and you can just kind of scroll down, you can see there's a lot of red here, and there's a lot of names that I'm following, and a lot of them have taken big hits. And so you may not see it right now if you're just looking at the indices, but there's been some pretty good damage done to a lot of equities right now, and there's a lot of red across the board. And so it's a matter of making sure that we don't get punished too badly while we wait for the market to give us a better opportunity. So with those pretty long-winded opening statements out of the way, let's take a look at the S&P 500 and spy a little bit more closely and look at the levels a little bit more and analyze what we consider good support and good resistance, right? So, like I said, we're in a pretty good channel. There's a pretty decent chance that we find support here. This often happens as you bounce back and forth between the 20 and the 50, which is probably the two more important areas to look at when you have a strong trend in place. If that's the case, we're already at pretty good support here around 406 to 405, and if we bounce, we're likely to go right back to the 20, and then I think that will be the turning point. I think if we get rejected at the 20 again, we'll lose the 50 and head down. If we bounce and get above the 20, well then it might be that we've already kind of corrected what we needed to correct for the month, and we need to come back up and retest highs and really figure out whether we have found a ceiling for the price action in the next few weeks to months. It's usually one test isn't enough to really define whether we have a ceiling or not. And so it could be that we still need to retest it. Now, if we don't hold it to 50 and we lose this moving average, well, we're going to lose this trend line, which is not really that significant of a trend line to begin with. Although lately it's been becoming a little bit more definitive of the price action. And if that's the case, we probably come all the way down here to 397, and this becomes a very critical area, a relative area that has already broken on the Nasdaq. And what I mean by that is, if we come back and we backtrack to what happened in February and March, that was the last time the market really threatened to kind of correct and to roll over. And in the end, it did not. However, this was a volatile trading part or trading point in 2021. Up to that point, it was the most volatile part. And eventually, we resolved to the upside and kind of climbed steadily. You'll note the candles got a lot smaller, so volatility died down after we kind of left that area. And now volatility is starting to increase, and we're coming right back and meeting that area. So you want to move forward always if you're a bull, right? So you don't want to come back and revisit this area. You want to stay above it. And so this becomes a critical point for the bulls to defend if they want to defend this bull trend. Now, the longer and longer this goes on, the less likely these kind of channels or this 45-degree slope continues. But what you could do is you kind of bounce, you break it, but you just trade sideways, and then you just resolve with a new leg up. Again, when we get to the Nasdaq, we'll see that that's sort of played out already as well. So in order for that to play out, you want to stay above this area. If we fall back down, and if we lose 399, 397, 398, then really the door's open for us to come all the way down to the 200-day moving average and down here to about 376, 375. So there's room for a lot further of a pullback if we don't hold at this level. So I think this is going to be a critical point for the bulls to defend on the S&P 500 and will be a major inflection point as to what we can expect in the coming weeks. Now, that can happen as early as next week, or it could be that it doesn't happen until June or July or possibly beyond. And a lot of that will depend on what happens here as we kind of try to bounce off the 50-day moving average. If we get a good bounce and get back above the 20, well, then we won't visit this area probably for a while. However, if we lose the 50, or even if we come back to the 20 and get smacked down again, then we visit this area pretty quickly. And like I said, I think that this will be a critical battle zone for the bulls and the bears, and is an important point to watch if you are concerned with what the market's doing and if you're worried about a further drop. And if we get to that and it starts to look like we're going to break down, I think at that point it becomes a little bit more important for us to start looking at how we want to manage risk in case that we really do transition towards a more negative market in the near future. But like I said, I think long term there's a lot of room to go, and we're still fine, right? I mean, think about how far we would have to drop just to get to where we were in the middle of last year after we had already kind of rallied up very strongly. So I think long term we're still fine. Like I said, I think it's more along the lines of what we can expect in the short term, and whether in the intermediate term we are starting to kind of see the ends of this particular rally that we've just had, which again was a very nice rally that started maybe around the holiday season and has inflated a lot of people's trading accounts. And it's always, you always kind of anchor up to whatever the last high was, and you tell yourself, well, that's the value of my account. But the truth of the matter is that even if we lose a lot of value here, most of our portfolios are still going to be up compared to where they were even just in the middle of last year. So there's plenty of room here for us to kind of wait and see what happens, and just make sure you protect yourself if you are too worried about what's going to happen next. But like I said, we're still kind of transitioning, and I think that there's still potential for us to kind of chop back and forth depending on what happens. Now, upside, like I said, if we can break the 20, I doubt seriously we break past 422, and if we do, it'll be by a tick or two. I don't think that we really start a new rally yet. I think that we'll just be chopping back and forth. In this area here around 411, it's going to become kind of important as well. If we do bounce today or tomorrow, it could be that we don't even get back to the 20, that we fill this gap and falter. Although I do suspect the 20 is a little bit more significant, and I think that it's more likely that we do bounce back up into the 20 if we sustain the hammer that's building up today. But if we close at the lows today and we close below the 50, pretty good chance tomorrow we head right down here to 398, and we start to really figure out exactly whether the bulls are ready to defend or whether they want to wait a little bit longer and wait for further value. And like I said, this is normal market behavior. This happens all the time. Uh, the market is always going to seek out what it considers to be value, and the majority of capital will wait until what they consider to be a good discount before they enter. So it could be that the bulls are waiting for 398, or it could be they're waiting for the 370s, and we'll just have to kind of wait and see what happens. Now, as I alluded to earlier, the Nasdaq already lost the trend that it had that began last year, and as you can see, it did already kind of break down. But as you can see, it wasn't the end of the world, right? We broke down, we traded sideways, and then we started a new leg up and tried to make new highs, which we did. However, much like the rest of the markets, we really weren't able to sustain price action above it. So this is what I mean about starting to define what the ceiling is for a potential range. And it could be that this is going to be a ceiling that's in play for another month, or it could be in play for another year or two. And if that's the case, we're going to see a lot more back and forth, and likely going to see further downside until we establish what the floor is. And like I said, in the short term, the market established the ceiling. And it's in the process now of trying to figure out what the floor is. And as you can see with the Nasdaq, we did not support or did not defend this zone that was developed in February, March, and April. We lost that pretty quickly. And we lost the 50, we lost the 20. So if you consider the Nasdaq to be a leading index, which I do, there's a pretty good chance the S&P 500 and the Dow Jones will follow suit and will break these reference points and start to trade lower as well. And that's been my thesis really since February, and why I thought that we were transitioning towards a sideways market was because the leader had already started to do that. Now, there is this idea of sector rotation which has been in place, and that's part of what's been going on, and that's part of why the Dow Jones in particular has done well, is because a lot of the digital or a lot of the tech names that did well in 2020 are the ones that have started correcting first. And some energy-related names or travel names started to do better. However, I think we just look at the markets as an aggregate, I still consider tech to be the leaders, and the fact that they are losing momentum, I think bodes poorly for the rest of the market, regardless of what relative strength is kind of still seeping into the Dow, or in the S&P 500 with respect to the Nasdaq. And so I still think in the long run, the Nasdaq is going to be the one that leads to where we're going next. And the fact that it already broke the 50 and the fact that it already broke below this red line, like I said, probably bodes poorly for the overall markets as far as the next few months are probably concerned. And so now the case becomes, do we head straight down and test the 200-day moving average, or do we chop a bit while the other indices, the stronger ones, try to pull us back? So there's a little bit of tug-of-war going on between the Dow Jones and the Nasdaq, and we'll get to the Dow in a second, and you'll see the difference between the two. But right now, the Nasdaq is really trying to drag down the rest of the markets, and until we see a change in that, I would expect the markets to either chop or to kind of correct a little bit further. You might ask yourself, is it a good time to buy the dip? And I would say probably you want to be patient and wait a little bit further as far as tech names are concerned, as far as the Nasdaq is concerned. We had an impulse down, we traded sideways. We had an impulse down, we traded sideways, and we are now having another impulse down. We could stabilize here, and if that happens, it'll likely be with the S&P 500 defending these points that we just saw. But if that happens, the Nasdaq is probably going to just bounce back to these moving averages that are now beginning to kind of turn sideways and probably get knocked down and come right back down. So I think at the moment, even if we did bounce, and these two red candles don't suggest a bounce coming tomorrow, but supposing we did bounce, it would probably be pretty short-lived, and it would probably be met with more selling pressure and probably another attempt at a leg down. So I think at the moment I'm not that concerned with trying to trade this to the long side, and I'm just waiting. I'm waiting for more established support than what we're seeing at the moment. Now, what are the levels? Well, I think I just kind of pointed them out to you. The first one is 316, which is where we are. If we lose that, we probably come down. There's a level here right around 311, but I think that we lose that and we just tested the 200-day moving average. I think if we break down below 316, 315, we're probably just going to go down and eventually test the 200 one way or the other. If we do kind of bounce, well, it's pretty clear there's going to be a major confluence of potential resistance right now, right here with the 50, the 20, and this kind of intermediate price point around 328, 329. And all of them are going to kind of combine to force a lot of selling pressure. It's going to be very hard for the Nasdaq to be able to break through that little barrier there and make its way back up to highs. Now, it could happen, and if it does, if we actually break above that, that's a very bullish sign and shows that maybe we've saw the correction we needed to see in May. But even then, there's a pretty good chance we just come up and redefine the ceiling and then kind of come back down and start to check to see what's happening next. Like I said, I think at this point the moving averages are giving us a good idea of what's happening, and even though they lag price, so you don't want to always use them as a predictor, I think if you're analyzing the environment that you're in, it's important to kind of look at them because they're clearly telling you what's happening. And right now they're clearly showing a sideways environment on the Nasdaq. And until we see a different picture, we just assume that that's what we're doing. And like I said, I think that more likely than not, we're going to come down and test the 200-day moving average. And I think at that point, that's when we start looking at what's a good buying opportunity and buying some of these, maybe some of these FANG stocks or some of these other tech stocks that did well last year as possible plays again. Until then, we just kind of sit in our hands and wait to see. Now, this is probably one of the more bearish looking of the four indices. If we take a look at the Dow Jones, we'll see a little bit of a different picture. As you can see, the trend is still very much intact. We did kind of pull back a bit. We are holding for the moment right at this little range that we kind of mentioned last week. Holding at the 50, we can see a hammer developing just like the S&P 500. Unlike the S&P 500, there is room to lose the 50 and still stay within our ascending channel. So the Dow Jones is still outperforming the other indices in the short term. It's, like I said, playing tug-of-war with the Nasdaq. It's trying to be the bullish index. And again, a part of that is sector rotation into some of the few Dow holdings that are doing well, based off, again, the whole recovery thesis. And if that's the case, it could try to bounce again. But I think overall, we're going to need to see a lot more bullish action. Right now, it's bullish just by the nature of it being relatively stronger than the Nasdaq. This is still an index that has flipped from looking for highs as to looking for lows and looking for buyers. Right? We had this 3-day drop, and then we kind of bounced and we've head back down. Right now, the Dow Jones is just like the other indices. It's looking for buyers, it's looking for floors, it's looking for support. So it's trying to probe as low as it can to figure out where buyers will defend. And at the moment, buyers are defending the 50-day, and they're defending this 337 area. But if they cannot hold that, then it's going to come right back down to this ascending trend line and maybe a gap fill right around 331, right in this area. And it could be that holds because, again, the relative strength of the Dow, when it comes to this, the Nasdaq and the S&P 500 will be at other levels that are a little bit lower and offer more staunch support as well. However, there is room that we drop maybe down to 320. Now, this wouldn't happen unless we see a drastic move down on the Nasdaq and the S&P 500. We're talking moves straight down to the 200-day on the Nasdaq, or on the S&P 500, a move straight back down to about 380 or so. And if that's the case, then the Dow Jones is going to probably come down and start testing this 320 area. And I think at that point, that would be a pretty clear indicator that all of the indices are done rallying and are going to shift towards sideways price action. Because in that scenario, all these upwards or ascending channels will be broken. For now, however, the channel on the Dow is not broken, and until it is not broken, we're going to assume that it's going to be the index that wants to try to push upwards and try to kind of keep pushing us towards highs instead of following the Nasdaq down. All right, and so those are the key levels. And again, pretty simple on the Dow Jones. Really, it's the moving average, the 50, the 20 to the upside, or a little bit above that around 345, and then this channel. And if we lose this channel and this gap around 330, then we head down to 320 or so. All right, here's IWM, and much like the Nasdaq, it has already graduated towards a sideways price action. We pointed this out last week. We pointed it out for a few weeks now. And at the moment, it's found a floor, and it's trying to stay trading sideways. But depending on what we see with the Nasdaq and with the S&P 500 and with the Dow, it could be that the IWM loses this. The small caps have been throughout the last probably 5-6 years at the least. It has been the index that gets hit fast when we have a market that corrects. We haven't had a strong correction other than the coronavirus drop last year, of which IWM got hit really hard. But any time that we've had a sideways market or a market that's more corrective in nature, IWM has performed pretty poorly, as that's the more volatile area of the market. The traders are going to be more quick to exit when they want to start trying to rein in risk and start trying to limit their exposure to the overall markets. So if we are going to experience a further correction, we're likely going to see IWM drop pretty quickly. So we need to watch it. There is an intermediate support here around 211, but really the key support or the key floor is around 207. If we lose that, I think it's a pretty quick move down to the 200-day moving average. And then from there, we likely bounce, but then kind of head up and retest this 207, which will likely become a very big wall of resistance. So if you are hoping for a more bullish scenario, you want IWM to maintain this range. It's still pretty tight. While this is already a pretty good sideways range, this is not wide enough to be considered a multi-month to year range, right? What I mean by that is if we go to the weekly chart, you take a look at what IWM has done. Again, you can see not quite as strong as what we saw with the S&P 500, but you'll notice when you have these ranges that last a while, they're usually pretty wide. And as you can see, for the most part, this next range was even wider. Basically, this was what IWM did for 3-4 years, right? From 2017 to almost the end of 2020. It just traded in a very broad sideways range. What we're seeing now, if we expect us to go into another one of these broad ranges, this is not wide enough. This is not. It's going to have to be something like this, right? So there is potential downside here if we are expecting a market to kind of transition towards one of these broader sideways ranges. So I think IWM is a good barometer for us as far as what the market is doing, depending on what it does at this floor. If it loses this floor and heads down and starts probing lower, I think, again, that's another good signal that the market is done rallying and is ready to start trading sideways and is really going to have to figure out where the floor is. Like I said, right now, this is not going to be a sustainable floor for a longer-term consolidation range. It's going to probably be much lower than that. So we'll see whether this is the case or not. Now, if we defend this, then I think that's the bulls trying to stave off the potential for a longer, broader consolidation, and are hoping that this is just a stair step and we continue rallying like we did last year. And that is a possibility. I don't want to sit here and say that we are 100% ready to kind of go back into one of these 2015 to 2017 ranges where we just go sideways back and forth all year. I think that that's probably where we're going, but it's not a certainty. 100% not a certainty. And there is very much the possibility that we continue to print money, we continue to devalue the dollar, and people's capital has to still stay in the market because it's the only place they're going to get a return. And if that's the case, we can see another nice strong rally, and we'll break right through all this and continue upwards. And I think as long as we don't see strong signs of inflation, the Fed is going to keep trying to do that. So there's still a pretty good chance that we just bounce right off of all these levels that I just pointed out, and we make our way back to highs and possibly beyond it. So I don't think we're ready to jump the gun, but I do want to point out that I'm seeing a lot of eroding price action, and I think that there's a pretty good chance that we are going to need to trade sideways for a while. And if that's the case, like I said, these floors are likely not going to hold, and we're likely going to kind of push down and maybe test the 200-day moving average across the board. and then really try to figure out where the floor is going to be for that range. But until that happens, we just got to trade the environment that we have. And with IWM right now, the floor is going to be 208 until it's broken. And once it's broken, it's going to likely be the 200-day moving average. Now, that being said, even if we do find a bounce, I feel like there's not a lot of overhead potential here. There's so much selling pressure here. And again, you can see what happened. We kind of dropped down. We found support. We came up. We got smacked down by the moving averages and came down. We're going to have to get above the moving averages. And more importantly, we're going to have to get above 226 if we are going to kind of want to start pushing upwards and through the recent ceiling and price action. And if that happens, then the bulls won, and we're likely going to rally forward, and we'll see that on the Dow Jones probably before we see it in IWM. And if we fail, then we're going to see lower price action. So, in conclusion, looking at the four major market indices, I would say that we are not in a good place for us to try to be aggressive about trading. As you can see, there's a lot of uncertainty. There's a lot of bearish patterns. Really, none of the patterns are bullish at the moment. Although if we do see bounces across the board at our current levels, then they could flip to bullish pretty quickly. What that means for me is, of course, like I said earlier, I am pretty much sitting on my hands. I'm only cherry picking the best trade setups that I find, and I'm only taking them if very specific criteria are met before they go ahead and take place. And if not, then I just watch. You know, it's when you have a market like this. I haven't mentioned this in a while, but those of you, if you're regulars, you've heard me say this before. You want to protect your capital, but it's more than just protecting your money. You want to protect your mental capital, right? It's very easy, you know. Trading is a game of probabilities, and even the best traders take a lot of losing trades. And it's really easy to lose your confidence, or it's really easy to get kind of caught up in a rut, or to break your rules, or start changing your trading setups because of short-term fluctuations in the market. That's one of the reasons I really try to analyze what kind of market environment I'm in, is to understand if the reason my trades are losing, is it because I'm trading poorly, or is it because the market conditions are poor? And so when the market conditions are poor, I tend to start trading much less, because you don't want that doubt to start to creep in that you're making bad trades, or that it's your fault that the trades aren't working. A lot of times the trades aren't working because the market's not giving you anything. And conversely, when the market is giving you stuff like it did towards the end of last year and the beginning of this year, it's really easy to pat yourself on the back and to say what a great trader you are. But in reality, it's the market just gifting you with good trades, and you just want to make sure you take advantage of that and kind of really extract as much profit as you can, because you know the conditions will not always be that way. And so right now we're protecting not just money, but we're protecting our mental capital, making sure that we don't lose our confidence or struggle and start trying to change what isn't broken. The market maybe is what's broken right now, not necessarily your trading style. Okay, so let's take a quick look. You know, with the big correction I saw in cryptocurrencies last night, and with the market being down, I expected the dollar to actually be up, but it wasn't. It's really just kind of stuck here at the bottom of its range. It is setting up for a bounce. There's a pretty good chance that we do bounce here, and at least kind of stay within this range that it's been developing. But we'll see, because it's right at, just like the markets, we're at a pretty big inflection point on the U.S. dollar. I think if we see a further drop in the markets and we see even bigger corrections, there's a pretty good chance the U.S. dollar does bounce. If the dollar breaks down, then I think that will kind of give the markets a little bit of the break they need in order to kind of stabilize and maybe make their way back up. So keep an eye on the dollar, because it is affecting the way things are behaving right now. If we look at the individual currency crosses, we're going to start with the euro like always. You'll see that the euro, and again this is going to be inverse, so up is good for the euro. You'll see that the euro was able to break through a pretty key area around 121, 122, and make its way back up towards its previous highs. This is a bad look for the US dollar, but it could be euro strength versus the dollar. As you can see, the dollar, if you look at the UUP index, it was still kind of holding at support while it lost support versus the euro. So keep an eye on this. Again, the euro US dollar cross is going to be the one that impacts the US dollar index the most. Now, if we look at the US versus the yen, we'll see a little bit of a different picture. The yen has been pretty weak, and this is the one chart where the US dollar has actually been a little bit bullish. However, it has pulled back recently, just like it has across the board. And like I said, the important thing is it looks like it's setting up for a bounce. There's a pretty decent level of support right around here, and it's getting pretty close to that. So there is a chance the U.S. dollar bounces soon, and if that's the case, like I said, that could put extra pressure on the markets as well as other commodities. And then the last one we want to look at is the U.S. Canadian. And now, interestingly enough, the U.S. Canadian has struggled, and you can see we finally saw a little bit of an attempt at a bounce, and it got rejected pretty quickly. Now, this one is very tied to oil. Oil is breaking down as well, so I would expect a bounce to occur here. And Sam, if you're in here, if you're still trading Forex, this is a possible trade for anyone that is looking, can't find anything to trade. This is an actual possible trade you could take if you are someone that has exposure to Forex trades. There's a decent chance we get a bounce here based off of this. If you take a look at crude prices, you can see that we had a pretty nice firm trajectory up, and then we broke down today. Now, it did rebound, and there's a chance that this is a hammer that holds and we get right back up above 60. But if oil rolls over and it loses the current area that it's at, if it loses, say, 63, it comes down to the 50, starts breaking below that, we will see a likely bounce on the U.S. Canadian as it makes its way back up to, at the very least, back up to 122, which is pretty decent, and possibly even beyond that as it gets its to the 20 and maybe even the 50-day moving averages. So, the market's not giving us much. Cryptos are not giving us much, which we'll get into in a second. But maybe we could find something here with currencies if the U.S. dollar does indeed bounce in the near future. And then finally, the one area the market, or the one area in general that actually has seen positive price action is gold and silver. Now, if you follow me regularly, you know I'm not a fan right now of gold and silver. They did flip the script a bit and have bounced, and I mentioned that there was a pretty good chance they're going to bounce. I'm still not trading them. It could be that they're flipping to a spot where they will be tradable, and clearly I kind of missed the boat a little bit because they were. But I found other areas of the market that I found more appealing. However, they have definitely started to pick up some steam. Now, that being said, if we look at the long-term picture, there's still a little bit of work to be done here. Now, if I could go ahead and reappropriate this. This is a nice breakout on GLD. And it could be that maybe it's done with this big correction. And if that's the case, it could be worth trading again in the near future. For me, it would have to come back down and retest somewhere around 172 and maybe give a good, nice little pattern like what we just saw in the U.S. Canadian, at which point then I'd be a little bit more excited about trading it. If we look at SLV in the long term, still kind of sloppy, still trading sideways. This is still very, this is why I've been kind of staying away from them, is there's still a lot of choppy price action. And so we are seeing good moves in the short term. And you can see SLV actually has had a nice little channel developing for a while. But I've just found other areas that I found more appealing than this. Now, that being said, they are starting to behave a little bit better, and it could be that we can get better trade setups on them in the near future. Now, with silver, I think it still has work to be done. But that being said, if it comes back down and starts to trade at lower levels and offers support and gives us a clean pattern, then we can start looking at it a little bit more, a little less negatively if it comes back down. But for now, I'm still not trading it. I'm still not that excited about it. It is trading nicely, but I still like more volatile assets that give me a little bit better return than what I'm seeing here. And then finally, we have kind of big news for today. The big drops in the cryptocurrencies. You can see Bitcoin dropped quite significantly. We did have a pretty big bounce, and we're going to see that across the board on any cryptocurrencies that we follow. I don't know if this is done. A lot of times when you see these really volatile events, you get a nice bounce, but it's not always a V bounce. A lot of times what happens is you have to come back and explore this a little bit more to make sure that there is enough support here with this wick. But as you can see, Bitcoin did drop all the way down to 30, but it was bought immediately and pushed right back up to 40. Ethereum took a big hit as well, and you're going to see massive wicks across the board. My impression is that this had to do with China, and I think they were again trying to ban crypto trading, and I guess this was a big liquidation event. I'm not sure if that's the exact reason or not. I usually follow charts more than I do news, but the key here is not necessarily whatever the news was, but the reaction to the news, which is pretty negative in the short term. Now, like I said, these were some pretty massive discounts that have been bought up already. The question now becomes, how much more of this wick needs to be retested before we get a real change and a real bottom forming? And it could be that we need to come back down, test the 50, come back down and test somewhere around here for Ethereum. With Bitcoin, it could be that we are already testing the spot right around 40, and it could be that we find support here, or maybe we need to come right back down and test 35, 36. If you are someone that has been looking to get into cryptocurrencies and has felt like they're too high priced, if you don't mind volatility, we will have nice buying opportunities starting already today if you're really aggressive. Although I think that personally I would probably wait a little bit more if I wasn't involved yet and wait for a reversal pattern. But we just got a big discount across the board, right? You take a look at Ethereum. Ethereum was trading at 4,200 and it's now trading at 3,000, right? That's a pretty big discount. If you were looking to try to buy it at a discount, right? If you're trying to look at buying Bitcoin at a discount, it was trading close to 65 in the 60s, and now it's trading at 40. Again, that's a 33% cut. That's a big discount if you wanted to get involved. If we go across the board, you can see I have a lot of cryptocurrencies I like to follow. All of them are down 20 to 30%. 18, 13, 25, 10, 16, 19, 12, 16. All of them have taken big cuts across the board. If you wanted to get involved in cryptos and you always felt like they were, you missed the big move on them, well, you're getting a big discount now. Now, do you buy just because they're down 25? No, I think you still want to wait to see just where we find some stability and where they bounce. Some of them, like maybe Matic, have already started to bounce and really weren't hit that hard to begin with. But there are others, VeChain, for instance, although this one's kind of difficult to trade because it's on Binance, but that maybe are going to have to come back down, and you could find good support levels on them and see where they go. You can see some of them are holding up pretty well. Some of them are maybe not holding up quite as well. And the key is to figure out what good support levels you want on them and where you think you could go ahead and buy. Now, you can look at the bottom of this wick and say, well, I'll go if it tests the bottom of the wick again. I think if it tests the bottom of the wick, it probably going to push below it. I think at this point, what we want to see in a bullish scenario is where it retraces a portion of this wick, but not the entirety of it. I think if you're looking for, say Bitcoin, let's say you don't want to mess with any of the smaller cryptocurrencies. Let's say you just want Bitcoin. If you're looking for 30,000, you're probably not going to get that. And if we do get that, it's probably not a good sign. So if you're bullish on Bitcoin, or if you wanted to get involved, I would say watch it now. See what happens as we start to break this downtrend. See exactly where we get a reversal pattern. But if the reversal pattern is all the way at 30, that's probably not good. You probably want a reversal pattern around here, where we just break the 20 or the 200 for a little bit, and then get right back above it, and then maybe try to buy from there. If we get back to 30, there's, I think, probably a pretty decent chance we try to push lower. But we'll see. It should still be a good area for buyers to step in. But I suspect that was a liquidity event that is probably not going to be revisited right away. And so if we do get a strong bounce, it'll probably happen before we ever get back to 30. All right, and so those are my thoughts as far as cryptos are concerned, as far as basically trading everywhere. And as you can see, trading across the board is not going to be easy right now. Crypto trading just got a lot more difficult, and it started to get difficult basically when Bitcoin rolled over. Ethereum, basically, Ethereum and Bitcoin have been playing tug of war, just like the Nasdaq and the Dow Jones, and Bitcoin ended up winning. As typically happens, the leader usually is the one that wins. And Ethereum kind of fell back. Now you can see Ethereum still has a pretty bullish trend. And I don't think it's necessarily done yet. I don't think it's got a fork sticking out of its back where it's going to kind of roll right back down and crash or anything along that nature. But it's not going to be the same easy trading that maybe what we saw in April, in the beginning of May. And it's going to be a little bit more volatile and a lot more back and forth. And so as you can see, trading has become more difficult with cryptocurrencies. It's become more difficult with the regular financial markets with stocks. And even to a certain extent with oil and with gold and silver, it's been more tricky and more difficult because they've been navigating their own kind of crazy ranges. And so, like I said, at this point, I've become a lot more conservative about how I want to go ahead and approach trading. That it's the old cliche, sell in May and go away. It's been a while since we really had a situation like that where basically the summer months were completely ignored. But it might be the case this year where as we start to lose volume, if we continue to maintain this kind of back and forth action, particularly in the stock market, it could be that we just need to be a little bit more passive about trading. And if that's the case, I'm going to offer, since no one seems to have a chart request today, my closing thoughts will be, if we do get into a more passive type of environment, where swing trading is much more difficult, it could be that you just want to go ahead and look at more dividend stocks, right? And so as you can see, I might watch this here, right? I've got the FANG stocks, Facebook, Amazon, Google. But just below that, I have a little list here of stocks that maybe there doesn't seem to be a kind of a theme. But what this is these are some of the stocks that have that pay decent dividends, and are not the greatest stocks as far as beta is concerned. They kind of go sideways often, but they give you decent dividends, and it could be that we're going to have to maybe look along these lines. Maybe I'll do a video or an article on something along this nature. But you can see something like this. If you look at a few of these, they've been holding up okay. And it could be that we need to just focus on stuff like this that gives us dividends, and a little bit less on trying to get directional moves in the market if the market is not going to give it to us. So it could be that we're going to have to look at a few of these. And I have a watch list with a few decent ones, and it's enough to kind of keep someone's portfolio filled if you wanted to go wrong along that direction. So that might be something we're going to have to start approaching and start looking at a little bit more closely. That was actually my plan of action at the start of the year. And to go back to what I mentioned at the start, well, these will be our closing thoughts. You never know what the market's going to give you. And my thought process as we started the new year out was that we were likely going to start trading sideways and start to see a more difficult market. And because of that, I wanted to shift towards more dividend-producing stocks and a little bit less on directional plays. The market didn't give us that, though. It gave us a nice rally, and so I abandoned that plan right away. I didn't try to stick to what my theory was, and ignore what the market was giving me. So I kind of put those on hold, and I just took what the market gave me, which again was 5-6 months of very strong price action. Now that it looks like maybe we're starting to see the scenario that I thought was going to take place at the beginning of the year, I can start looking at those types of plays a little bit more. And so that's something we're going to be examining a little bit more closely, especially on my Patreon page. And if, again, the market bounces and continues this strong rally, well, then we put that in the back burner and we go back to trading the momentum and just, taking whatever the market gives you. So I think that's the key. The general thought process of what we do with these Wednesdays is we want to see what the market's given us, and we want to make sure that we're just taking that and not trying to do extra and not trying to pigeonhole or force a trade into an uncooperative market. And if the market is not giving you breakout trades, don't take breakout trades. If the market's not giving you shorts, don't take shorts. If the market's not giving you bounce trades, don't take bounce trades. And just wait to see what the market's going to give you and then try to take those. And so if that's the case, we'll kind of roll with the punches and see what's next. Okay. So, like I said, that covers it for today. If anyone has any questions, feel free to type it. If not, we're going to call it a day. Also, like usual, if you, for whatever reason, can't ask me on here, or if you're watching this as a recording, find me on Twitter and ask me. Just message at StockDarts, and I'm more than happy to answer your questions there. If you're not the kind of person that wants it public, just ask me in a DM, and I'll just message you on there. Other than that, hope you guys have a good rest of the week. Hopefully things stabilize for you. You're not taking big hits right now, and are not suffering through some big corrections. Other than that, I'll see you guys next Wednesday.